Now, how many unit trusts in South Africa, and these are actual numbers, actually outperform the index over time? So you say, well, after a while, they should do quite well. I mean, 20 years, you expect most of them to outperform the index, but only 10% of all actively managed unit trusts. We're not mentioning any names here, but this is Coronation, Allan Gray, Sanlam Mutual, whatever the name they've got. 10% of them can actually beat an index. Okay? And if you say, well, okay, maybe over short periods of time, they're a little bit better. But if you look at short periods of time, 6 months, 1 year, and so on, you find that 80% of all active managers in South Africa can't actually beat an ETF, the average return of an index. And so you say, well, is South Africa quite poor? I mean, can't we play rugby? I mean, we can play rugby. I mean, we beat the All Blacks. We can play soccer. We beat Congos. There's nothing wrong with us. We're quite good. Are we bad managers? Well, the worldwide, that's a general phenomenon. But there's a so-called Sharpe ratio, and the Sharpe ratio, named after William Sharpe, who won a Nobel Prize, and he said, listen, the average returns of a market, 50% of the people in a market will outperform the market, and 50% will underperform. But if you start taking costs into account, because these guys charge you fees to do that, on average 70% of all the active managers in the market will underperform the index, the average return of the market. And in South Africa, it's 80%. It just says that South Africa has much higher fees than the rest of the world. And that's one of the phenomena in South Africa. We have very high fees. So what I'm also saying here is if you just buy the index, you're not buying bad performance. You're going to outperform 80% of the people out there. So I'm not saying that you aren't smart enough to pick the 1 or 2 unit trusts that will outperform the index, but you're smarter than I am. Because the guy who outperforms this 6 months is not the same guy who outperforms over the next 6 months, because there's a lot of volatility in performance. So buying ETFs is a nice, safe, low-cost way of investing in the market and getting returns on portfolios of shares. And those numbers, I mean, the industry hates those numbers, but those are well proven in the South African case. So the case for ETFs, you're buying an index, buying a very nicely diversified portfolio. The diversification reduces your risk, increases your exposure, so it increases your potential for performance. The costs are very low, and you're outperforming most of the guys out there. So if you want to make Allan Gray rich and these guys can drive more Ferraris and have sort of smart clothes and all this, that's fine. Otherwise, just buy an ETF. Okay? And I don't have any smart clothes. Or you can see my old Tory in the garage downstairs. So ETFs are poor man's products, but they outperform 80% of everybody out there. And that's why they're becoming the most popular retail product in the world. 70% of all new money in America, retail money, which is investors like you and me, put money now into index trackers like ETFs, which exchange-traded products. Now, there's just 2 things I want to talk to you about, because every time I do a presentation, somebody asks me this question. Exchange-traded products is a generic term for a product that's listed on the stock market that gives you access to an index. And there's 2 types of exchange-traded products. There's ETFs, exchange-traded funds, which most of you know about. What an exchange-traded fund is that the rules of the JSE say that the manager who's tracking an index has to hold 100% physical underlying of that index. So if he's got 100 million rand invested in the top 40 index, he has to exactly replicate that top 40 index. He has to own 100 million rands worth of top 40 shares and exactly the weighting that the JSE allocates to that index. And there's all sorts of reasons why he has to do that, because there's a swap between the physical and the cash and all sorts of things like that, which I won't go into the technical details, but ETFs exactly replicate the index. So they're 100% physically backed. So they're completely collateralized. If you go and buy a top 40 ETF or even a DBX tracker overseas ETF, that guy will own 100% of the underlying index. So there's no risk for you. And he doesn't hold the shares. They're held in an insolvency remote trust, what we call a collective investment scheme, and the trustee is not appointed by the ETF manager. The trustee is appointed by the FSB, Financial Services Board, and approved by the JSE. So you have an external trustee who holds the portfolio on your behalf. So they're safe. They're not only regulated by the Financial Services Board as collective investment schemes, but they're also public companies listed in the JSE, and most of the floors above us are regulators in the JSE. So they're making sure that these things do what they're supposed to do, which is to be 100% collateralized and 100% holding of the underlying shares. So they're quite safe products. There's only 2 things that can go wrong with ETFs. The market can go up or down. What's it done the last 2 weeks? It's gone down. What did it do today? It went up. So you've got some risk in the price of the overall index going up or down. But as you're exactly replicating the index, If you listen on the radio in the evening and you listen to Bruce Whitfield or Stevie B or somebody, and he says the index went up 0.5% today, your ETF will have gone up 0.5%. He says the index went down 1% today, your ETF will drop in price by 1%. And there's all sorts of structures in the market to make sure that happens. So an ETF always trades at the value, the net asset value of the underlying portfolio of shares. So that's an ETF. There's something called an exchange-traded note. The exchange-traded note is also listed on the JSE as a security under the same main part of the JSE board. But with an exchange-traded note, the issuer of the exchange-traded note doesn't physically hold the underlying asset. And typically that's because it's difficult to do. You know, exchange-traded note might be in something like wheat or oil. So now what do? How do you go and buy all that oil? You go and stick it in the basement of the JSE and the stuff goes off after a while. So it's very difficult physically to hold the underlying asset. So JSE rules says that the issuer of an exchange-traded note can cover his liability by using a futures or forward contract. And most of your commodities trade in futures and forward markets anyway. But if he's doing that and he's holding the underlying position on a futures contract, you then have to take into account the creditworthiness of whoever's issuing that note. So ETNs are a little bit more risky because they don't physically hold the underlying, but they hold the JSE requirements is that they exactly replicate whatever index they're tracking or whatever asset they're tracking, but they do it by the issuer guaranteeing that he's giving you the performance of the issuer. So then you've got to look how creditworthy is the company that's issuing this. And in South Africa, the JSE rule says you can only issue ETNs if you're a bank. So at the moment, the only ETNs in South Africa can be issued by investment-grade banks. If you're not a bank, you can maybe persuade the JSE that I can do ETNs, but they haven't allowed that yet. So the ETNs effectively issued by people like ETFSA, Standard Bank, and there's one or two issued by, in fact, those are the only two major issues of ETNs in South Africa. There's one or two issued by Investec. So you've got two types of exchange-traded products, ETFs and ETNs. Most people buy ETFs. ETFs, very safe investments, 100% collateralized, assets always held to support the products. Now, there are quite a few, as I think Mark was explaining, there's quite a few different indices. So when you're looking at ETFs, and it used to be easy when you started the business, and I started, I was the guy who helped launch Satrix 40, which is the first ETF, and that was only about 12 years ago. We only had one ETF. That was easy. Now we've got 70 of the damn things. Okay. It's not as bad as a unit trust because there's 1,000 unit trusts and there's only 450 shares in the JSE. So there's more unit trusts than there are shares, but that's another issue.